My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Diversification, 1. Concentrated risk, 0. That's how I look at the difference between Larry Fink's BlackRock business and the flagship ARK Innovation ETF run by Cathie Wood. Now, if you aren't familiar with these two, they represent two very different philosophies. And it's worth exploring what sets them apart. After a good day, where the Dow advanced 76 points, the S&P gained 0.39%, and the Nasdaq jumped 0.93%. Cathie Wood tries to identify major long-term trends and offers a highly concentrated way to invest in them through her actively managed ETFs, the largest of which is the ARK Innovation Fund ETF. It used to have $28 billion in assets, but now it's back down to about $9 billion. Larry Fink's BlackRock runs the largest fund group in the world with $9.4 trillion in assets. Wow! And they had $190 billion in net inflows just in the first half. Cathie Wood was once hailed as the greatest investor in the world, and she was absolutely the best stock picker of 2020. Most individual investors have no idea who Larry Fink is. Frankly, I think he wants it that way. But what matters here is the radical difference in their styles. Wood hitches her star to a few stocks that she thinks have the greatest growth potential. One of her biggest calls was getting in Tesla very early. Good call. Wood's strategy generated incredible returns when Wall Street loved growth. But when growth went out of style, so did her performance. Turns out, it wasn't a strategy at all, only a tactic. And a very risky tactic at that. Next thing you know, in 2021, she lost 24%. Hey, S&P finished the year up 27%. NASDAQ rallied 21%. Then in 2022, as she stuck with the same kind of stocks, her leading fund fell an astounding 67%. More than double the 32% decline in the NASDAQ and more than triple the 19% decline for the S&P 500. Why? Simple. Wood was undiversified. That gave her tremendous outperformance in 2020, but tremendous underperformance in 2021 and 2022, making things worse. She very visibly gave up on the stock of NVIDIA when it was trading at $234 per share. After sticking with it for years, she finally decided the valuation was too high. She even came on our network, and she trashed it. She called it another check-the-box AI company. Well, it's now just under $465. It turned out to be anything but just another check-the-box AI company. It was the AI company. Cathie Wood made a reputation picking stocks like NVIDIA, yet she sold the latest and greatest before the run. To me, that compounded the reputational risk of Wood's strategy with an element of cluelessness, frankly, about the fortunes of the companies she actually owned. It called into question her stock-picking ability, not just her worldview. That's the danger of running an undiversified portfolio. You have to be right every time, or else your investors, they get obliterated. In reality, nobody's that good to maintain this method over the long term, and they shouldn't tout themselves for doing so. Wood's inability to manage money in a strategic way, relying on a few hand-picked equities that she apparently doesn't follow as closely as I thought, has led to an investor exodus as her holdings like Coinbase, Zoom Video, Communications, Roku, and Block failed her in the last few years, even as they've been strong in 2023, and I'm going to give her that. They've been very good stocks. Now, it stands to reason money managers had to recognize that money-losing companies would see their stocks sell off in a situation with roaring inflation. You know, only Tesla and Zoom were profitable going into this period. Unlike Tesla, though, Zoom's trajectory rose and fell with COVID, plummeting from 588 at its highs to 72 and change today as the epidemic peaked and subsided. How do you not recognize that Zoom's unique nature was being commoditized by the likes of Microsoft, Cisco, Google, among others? I regard that as not great work. And look, I'm not saying Wood has lost her touch. I'm saying her whole concentrated investing style is self-defeating. You can't win like that year in and year out. Sooner or later, it will blow up in your face. Now, let's talk about Larry Fink. Larry thinks BlackRock, on the other hand, is the paradigmatic opposite of what Wood offers. Diversification is at the core of the company. It's at the core of the show, so you know it's going to be simpatico to what I'm talking about. Now, I had the opportunity to interview Larry on Friday with the rest of the Squawk on the Street gang, and his understanding of the nature of investing, I find, is unparalleled. He's not a tactician. He's a strategist, a broad thinker who attempts to guide you through all sorts of situations. His conference call from last Friday was loaded with wisdom and stratagems that were, well, gems. Listen to this one. Through our diversification and strong performance, we can help clients better match their long-dated liabilities, achieve their operational objectives, and streamline the processes, end quote. Now, while BlackRock's biggest group of investors comes under the rubric of institutional players, I actually don't think that matters. He's using judgment that shows you how money management should be done. I find it a learning lesson. It's a great tutorial. I've been at this for 42 years. It's a great tutorial. Listen to this. Quote, investors are facing a complex landscape of competing fiscal and monetary policies with a number of structural forces shaping returns now and over the long term. These forces include a fragmented geopolitical landscape, causing a rewiring of supply chains, a transition to a lower carbon economy, and the aging population in the developed world, all of which are likely to be inflationary over time, end quote. What goes around town now, inflation's crumbling? Fink acknowledges that while some indicators show inflation slowing, as he told us on Squawk in the Street, the trillions of dollars President Biden got for infrastructure and the environment is, well, by necessity, it will be inflation, no matter what, which could lead to continually higher interest rates longer than we thought. And you know what? I think he's going to be very prescient. Fink knows how to manage this risky environment. As he lays it out, his clients are, quote, focused on outcomes in the manifest in a portfolio of blending active index, private markets, and cash, end quote. You know what? That's called a strategy to keep you in the best assets over time, not a tactic either hit it out of the park or strike out. Now, I'm using these two different methods of running money to emphasize one thing. Human nature draws us to what's hot. It's a fact of life. Cathie Wood ran a very hot fund, maybe the hottest ever. The reason why people are bailing it now in record numbers, even as their flagship fund has increased in value this year, is that they've learned their lesson. A sophisticated attempt to manage your money requires someone like BlackRock to be your bedrock of your assets. Now, it's fine, by the way, to include a Wood in the mix, so to speak, as long as you recognize that she's a true gunner, even if she doesn't identify with that term. Fink, on the other hand, offers you a menu that will lead you over time to the safest possible outcome with the least amount of risk. Now, he won't always be right. Wood won't always be wrong. But if you want to be able to have the best shot of increasing the value of your assets longer term, you need a diversified strategy that takes into account the vicissitudes of both the moment and the longer term, one that keeps you from being blown out, as so many were from Wood's ARK Innovation Fund. It's a tough lesson. I always try to teach people that they should have most of their money managed in a diversified way, like Larry describes, while also owning some stock picks that you like. For instance, the Investing Club is an attempt to help you find stocks that can outperform the average mutual fund. Many of you come to me because you want to manage some of your money yourself, and that is precisely what we want. But the bottom line, what we don't want is your nest egg to be concentrated in just a few stocks that might be very wrong for the moment, causing you to give up on this entire wonderful asset class. And that is my fear. That is my biggest fear. BlackRock's diversified style is the antidote to that fear. Erwin in New Jersey. Erwin.
Hey, Jim. How are you?
I am good, Erwin. How about you?
Yeah, I'm doing great. A little warm down here in Monmouth County, but otherwise
it's hot. It was hot. It was 90 this afternoon. My collar's all sweating and stuff. What's going on?
A few months ago, we were talking about home builders, and they were on a tear. So I started to do some research, and I went to sectors, and then I clicked on industrials, and then I went to building products, and I came upon a company which I bought about 5 or 6 months ago, called Builders First Choice, BLDR. And that's also on a tear. It's a double for me, which is unusual, really. And I want to know your opinion of Builders First Choice.
Erwin, I've been thinking about Builders First Choice and Floor and Decor. And I'm thinking, are they the next Home Depot and the next Lowe's? And I've been working on this. And all that's happened is they keep going up. I'm waiting for a moment. All I have to say, Orrin, is congratulations. You hit it out of the park. And I sat there on the sidelines trying to figure out if it was as good as Home Depot, and you made the money. Well done. Doug in Texas. Doug.
Jim, I'm an old geezer. I'm 77, and I still buy and sell stocks, and I still listen to your advice. And,
all right.
About
Thank
5
you.
years ago, I bought that Walgreens thinking it was a good company. They seem to have been got their ox in a ditch and don't know how to get it out. So are they a hold, or do we treat them as a buggy whip company and just tell them to go bye-bye?
Boy, this is one of the hardest things. The yield is 6.5. They do have, look, they have levers they can pull. Absolutely. But you know what the problem with Walgreens Boots Alliance is? They are the ultimate brick and mortar in an era when Amazon's got them crushed. And theft, which they don't talk about enough, is just crushing their performance. So my take is to 29, maybe you can bounce 32. 32, then what I would say is sell, sell, sell. Look, if you want the best shot at long-term wealth generation, I think you have to stay diversified so you can prepare for whatever the market throws your way. That is the essence of this show. Well, Mad Money tonight, I mean it when I say we have the smartest audience in television, you. And last week, you called in and asked me about MYR Group. I didn't know it. Shame on me. Tonight, I'm turning my homework on the stock to see if we spotted a winner in the infrastructure group. Then, while everyone has been laser focused on the Magnificent Seven, there is another cohort of stocks that's actually been quietly rallying just as well, if not better. I'll reveal what it is and how you should interpret the action. And one of my favorite parts of this show is hearing directly from you. So we're taking some questions from the CNBC Investing Club members that we didn't get to the other day when we did our club meeting. We want to hear what's on your mind. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.